Ladies and gentlemen, good morning and welcome to the fabulous Balboa Bay Resort for our 2023 economic forecast. At this time, please welcome President and CEO of the Newport Beach Chamber of Commerce, Steve Rosansky.
Good afternoon. Well, actually, it's probably still good morning, everyone, and soon to be good afternoon. I'm Steve Rosansky, President and CEO of the Newport Beach Chamber of Commerce, and I want to welcome you to our 2023 Economic and Financial Forecast Luncheon. We have an exciting program for you today as we take a look at the economic forecast for 2023 and drill down on the state of California real estate markets. It's been a year since we last convened here at the Balboa Bay Resort, and what a difference a year makes. The stock market was getting ready to peak at an all-time high, and now we're flirting with a bear market. Treasury rates were at all-time lows, and now we have seen 5 hikes in the federal funds rate in the last year, with certainly more to come. A year ago, 30-year mortgage rates were hovering around 3%, and today, I think it was more than double, 6.7%. Real estate brokers, and I imagine there's a few of you out there, they acted more like auctioneers with 15 or 20 offers on each property. And now they actually have to sit open house once again. And finally, now stay in your seat, Chris. Finally, the bastion of investment, Bitcoin, was on its way to peaking at $67,000 per coin, and now can be purchased for the low sum of $20,000 per coin. But we're not here to dwell so much on the past as to figure out how we got here and divine what the future holds. And to that regard, today we're bringing you 2 experts in their respective fields, Chris Schwarz, Director of the Center of Investment and Wealth Management at the UCI Paul Merage School of Business, and Jordan Levine, Vice President and Chief Economist for the California Association of Realtors. So feel free to continue with your lunch. We have a number of VIPs here today that I'd like to introduce. And so first off, we'll start off with City Councilman and former Mayor Brad Avery is here with us today. Brad. City Councilwoman Joy Brenner should be here today somewhere. Joy, maybe she's running a few minutes late. City Manager Grace Leung, next to Brad. Former City Manager Homer Bludow. City Attorney Aaron Harp. Community Development Director Simone Jurgis. Planning Commissioner Eric Wigand, also a candidate for City Council. Finance Committee Commissioner Joe Stapleton, another City Council candidate. Chair of the Board of Library Trustees Paul Watkins. Newport Beach Library Foundation Board Member Dorothy Larson. Newport Mesa School Board President Michelle Bartow and Board Member Krista Wigand. Orange County Supervisor, she'll be sitting right here in a few minutes, I'm assured. Christina Foley. I saw him earlier with his trademark hat. Former Assemblyman Matt Harper. The Mayor Pro Tem for the City of Anaheim, Trevor O'Neill. Irvine Ranch Water District Board Member Pierce Swan. I hope he made it. The Dean of the Paul Merage School of Business, Ian Williamson. Coast College's Chancellor, Whitney Yamamura. President of Orange Coast College, Angelica Schwarz. The Chief Operating Officer for UCI Health, Nathan Shinagawa. The General Manager of the Epic Times Southern California, Siamak Karami. A good friend of mine and a board member, CEO of the Newport Beach Association of Realtors, Kim Foreman. And of course, our very own board chairman of the Newport Beach Chamber of Commerce, Chris Delfs. As expected, an event like this can only occur with significant support of some very special sponsors, so please let me present our 2023 forecast sponsors. Our gold sponsors are ACI Jet, City of Hope, Orange County, the Epic Times, Newport Beach and Company, Pacific Life, Shop Off Realty Investments, Spinnaker Investment Group, LLC, and Wells Fargo. Round of applause for them. Our silver sponsors are Orange County Supervisor, 2nd District, Katrina Foley, Newport Beach Association of Realtors, and Go Rentals. No. And of course, our supporting sponsors here today, UCI Paul Merage School of Business, the UCI Merage Center for Investment and Wealth Management, and the California Association of Realtors. And I'd like to extend a heartfelt thanks to Marina and her staff here at the Balboa Bay Resort for creating such a wonderful luncheon for us today and allowing us to use this room once again for our forecast. And also, the Newport Beach Chamber of Commerce is the host of this event. And lastly, I want to thank our table sponsors listed in your program and recognize the Chamber's Leadership Circle members that are here with us today. These companies support the Chamber at the highest level and underwrite many of our programs and activities, including today's luncheon. So at our platinum level are the Balboa Bay Resort, Hoag Hospital, ACI Jet, VEA Newport Beach, a Marriott Resort and Spa, Orange County 5th District Supervisor Lisa Bartlett, Orange County 2nd District Supervisor Katrina Foley, Newport Beach and Company, the City of Hope, Orange County, and Simple Green. Round of applause. Our gold members are the Newport Beach Association of Realtors, Picoco LLC, Julie Lawton Custom Homes, the Newport Beach Police Association, and Davies Locker. Round of applause for them. And certainly we have a whole bunch of Silver Leadership Circle members. Their names and logos are on the back of your program. So now I just want you to please enjoy your lunch. We'll be back in about 20 minutes to get our program started, and we'll see you then. Thank you. So as I mentioned earlier, our two speakers today are Christopher Schwarz and Jordan Levine. If I can invite you both to join me up here on the stage. Yeah, round of applause. So Chris and Jordan are going to make their presentations first. We'll have Chris, then Jordan, and then we'll have a round of Q&A afterwards if you want to stick around for that. And that's how we're going to proceed. So we've got a lot to cover, so let's get going. A lot of ground to cover. Let's get going. Christopher Schwarz is a professor of finance at UCI Irvine's Paul Merage School of Business, as well as the faculty director for the Center for Investment and Wealth Management. During his time at UCI, he has been published in all the leading academic and practitioner finance journals. His research has also been cited by the New York Times, the LA Times, the Wall Street Journal, and the Financial Times. And he's provided a number of economic forecasts in the local community, including a number for us throughout the pandemic and even before that. Chris was recently featured on CNBC for his groundbreaking research into no-fee trading. Prior to arriving at UCI, Christopher received his PhD from the University of Massachusetts Amherst, during which he was also a visiting doctoral fellow at Yale University's International Center of Finance. He received his BS from Babson College in Wellesley, Massachusetts. Please welcome Christopher Schwarz.
Hi, Steve. All right. Is my mic on? All right, good. All right, we're back. How's everybody doing? All right, so a number of you asked me if I was going to calm you down. I had nothing good to say. All right, so if you want the champagne and strawberries economic forecast, it was really good to see you. All right, you guys can proceed to valet. It's over there. All right, so as I always tell people, I'd rather be right than liked. That's my line I've used a couple of times today. So I'm going to get right out of the gate and just say we have a really kind of weird area we're in here, which is financial markets have been bad. Economic data hasn't been particularly good. And a lot of people have complained. Pretty much everyone I run into, they complain about the economy, right? So they just start whining about, gas prices or Disneyland tickets or the price of their Lamborghini has gone up. All right, and nobody likes a whiner. I mean, they really don't. I mean, it's great and everything, but I mean, the problem is that I think everyone goes home, they see financial markets, and they feel like Ben Bernanke. I don't know why I have Ben Bernanke's head in, probably because he was Fed chair the last time we destroyed the economy. But they probably think that Powell goes home every day and is like Bernie from Notting Hill, I botched up at work today, and just millions are down the drain, right? So, by the way, if you haven't yet, please don't check the stock market right now. It's not having a particularly good day today. But at the same time, all of you, or almost everybody, is still acting like Donna and Tiki Tiki Tom Tom from Parks and Recreation, which is clothes. Come on, there it is. Clothes, treat yourself. Fragrances, treat yourself. Whatever. They got massages. They got fine leather goods. You're just treating yourself every day, right? So I go to South Coast. I see everybody. You're just buying a lot of stuff, right? When it takes you 3 hours to get in the Hermes store, things are going okay, all right? So what's the problem? All right, so back in January, actually, if I was here a year ago, I think I had this chart up a year ago, the Fed was forecasting that we'd have an amazing year economically, right? So we'd have 4% growth, which was the highest growth forecasted for the last 25 years. And of course, then in April, we were down to 2.8%. Then in October, July, they're like, maybe it's only going to be 1.7. And then they redid their forecast a few weeks ago, and they said, well, now we're going to be 0.2%. All right, and I'm sitting here going to myself, I mean, who is making these forecasts here? Is it like Michael Bolton from Office Space? They missed some kind of mundane detail, like a decimal point, and they're mad at each other. So I have no idea what's going on with the Fed. All right, so the bottom line is, did I go backwards? All right, so you can see here that next year, for 2023, they're forecasting 1.2%, right? So you can see their forecast is much more conservative than what they had for last year at this point, right? So they're being very conservative about growth. All right, but just to be clear, all of you know that the Fed is raising rates. Steve already previewed that. All right, so just to be clear, the Fed is going to be raising interest rates at least another 1.5%. That's their forecasts, right? So we went from basically 0 to 4.5%. They think inflation is going to go down, and yet somehow we're going to have acceleration in economic growth. All right, so just to be clear, that's what their thinking is, all right? And so just to be clear, I feel like Cotton from Dodgeball, that is a bold strategy, Cotton. Let's see how that's going to turn out for them, all right? Because there's only one place I can possibly think where all three of those things could be true, and that's going to be Fantasyland. Well, where'd my Fantasyland slide go? Anyway, it didn't make it to the slide deck. I made some changes this morning, didn't make it. All right, so what's our problem? I was going to sing, too. I'm still going to sing. So why is inflation such a problem? And the problem is because everyone's saying, I'm flush with cash, just like, what's his name? What's this guy's from Park and Rec? John Ralphio, thank you. I'm flush with fluster because I missed my slide. That's okay. All right, so everybody's got lots of money. And why does everybody have lots of money? Because people misjudged, and I'm not judging people, even though we're judging, but they misjudged how much the pandemic was going to impact incomes. All right, so the way I look at money, so everybody has their way of trying to do personal income and all this other stuff. The way I look at personal income is through taxes, right? Because when people make money through capital gains or through money or whatever, they have to pay taxes. All right, so if you look here, so this is total tax receipts by year for the last 4 years. All right, and you can see here that the first line here, the blue line, that's 2019, right? So that was the year before COVID. And then you can see the orange line is 2020. And you can see, yes, we had a dip when COVID hit, but you can see already tax receipts by July of 2020 were back to where they were before the pandemic, right? So in other words, aggregate tax money by July of 2020 had already reached where we were in 2019. And now basically you can see tax receipts are like 50% higher than what they were in 2019 and 2020. All right, so again, I'm not a mathematician, but essentially that means that people are making 50% more money this year than they were 2 years ago, right? So people are making a lot of income. At the same time, we handed out a lot of checks. So you may have seen this graph before. I probably showed this last year. So we handed out $4.4 trillion of stimulus. All right, so we have all the stimulus. So people didn't really lose any income. Then we gave them a lot of free money. Oh, and then that wasn't enough, right? So this is like an infomercial, right? Oh, but wait, there's more. We decided that we didn't have to make people pay bills. All right, so how many people in here have a student loan? Just be honest. You can raise your hand. All right, you haven't paid anything on your student loan in almost 3 years now. So in January, you'll finally have to start paying your student loan. Oh, by the way, we didn't make people pay rent. All right, by the way, you didn't have to buy pants because you were on Zoom for 2 years. All right. By the way, I don't know about anybody else, but I was always terrified someone's camera was going to tip over. But maybe that's just me. All right, but anyway, we cut people's expenses, right? You'd have to pay for gas and this and that, and we're shocked that people feel really rich. So everyone is rolling like Elon, although Elon's probably feeling a little bit poor after he's way overpaying for Twitter, but that's okay. So this is total deposits by people at banks, and you can see it went way up during the pandemic. It stopped going up finally, but it's not like people have blown through their money yet. So this is deposits. This is consumer spending. So that's still doing okay. All right. So that's back to my Hermes 3-hour line of South Coast story. All right. So of course people have lots of money that they're still spending. All right. There's an article from the Wall Street Journal that not only are people still spending money, all right, but everyone complained about gas prices, and we had the most miles ever driven on Labor Day weekend, as everybody complained that gas is so expensive. They're still spending all of this on fun. And by the way, I have bad news for a lot of you in the room. Lambos are sold out till 2024. All right, just to show you how much money we have, I saw an Aston Martin here in Newport Beach 2 days ago. The license plate read IMRICH. I'm rich. I was thinking to myself, my God, that guy must be the biggest asshole on the planet. I mean, you're in an Aston Martin. Wait, 1 second. Does anybody here have a license plate? Okay, just making sure. All right? So everybody's got a lot of money. All right? So, and guess what? If we give everybody a lot of money, what are they going to go do? They're going to go spend it. All right? And so, what happens when everybody wants to buy anything? It's just like Ghostbusters when they got rid of the ghost. I had no idea how expensive it would be. I refused to pay it. Right? Every time you go to buy something anymore, you're kind of shocked at how much it costs, right? And I don't know what happened to that screen. Oh, it's back. All right. Apparently, the price of that screen went up momentarily. We had to pay a little bit more for it. All right? But pretty much everybody has too much money, and so, of course, we have a lot of inflation. All right? And so this is the way I've been kind of thinking about inflation, because when we started the pandemic and came out of it, I'm going to say we had some normalization in prices. Right? So back in April of 2020, you could pay minus $32 for a barrel of oil. Right? So someone would literally pay you $32 if you took a barrel of oil from them. Right? And the reason was because they didn't have anywhere to store it. Right? And I tried to store some in my backyard, and someone from UCI PD showed up. They didn't like that very much. Right? And that's why people would pay it. They call that storage costs. Right? So I tried to normalize things. So what I did was I took CPI, so that's total inflation over there on the left, and you can see it's over 8% right now. And then in the middle is the proportion of the bars on the left that are due to things like used car prices, all right, and the price of oil going back to what it should be at the time. Right? And then on the right-hand side is everything that's left. Right? So I got rid of used car prices and oil, volatile stuff, or stuff that's in the short term. And on the right, I have everything that's kind of long term, like housing. So if you think about those bars on the right, like half of that's probably rent. Right? And you can see that at the beginning, when we started to normalize, you can see inflation for normal stuff was below 2%. That's the Fed's target's 2%. And then you can see slowly but surely this thing has been building to the point now where it's at about 6%. So even if you took oil prices out, and even if you took used car prices out, inflation would be running at 6% per year. Right? And the bad news is a lot of that stuff on the right is very persistent, right? That stuff does not turn around right away, right? So if you look at something called like rent, so this is rent data from Apartments Listing and Zillow, and then I have the gray bar there on the bottoms, the rent index from CPI. You can see, it takes a long time for these things to really fully impact CPI, and the reason is because if you think about an apartment building, only 1/12 of the rents turnover every month on average, right? So it takes 12 months for a rate increase to hit everybody in an apartment building, and so that's why it takes a long time to hit the system, right? So it's not like tomorrow or whenever CPI next Wednesday when it comes out, shelter's all the way gonna be back down to 0%. It's gonna take a long time for shelter, which by the way is a huge portion of CPI to be back to normal. All right, the one thing that's good is you can see obviously that the year-over-year change in rents is all the way down to only 10%. I'm gonna put only in quotes there, all right? And you can see the same thing in used car prices. So this is used car prices. So you can see the price of a used car almost doubled for March 2020. All right, that just tells you how good Hertz was, right? They sold all of their cars in March 2020. And they could have made a fortune and then they doubled. But you can see the price of used cars is coming down. All right, so the story here of these graphs is inflation has probably peaked from the standpoint of the numbers, the headline numbers we're going to see are probably not going to go any higher than they are. The question becomes, how fast can we get inflation to come back down to something normal, especially when in some sense the data like housing and rent is going to be lagged in CPI, right? And that's going to be one of the big issues that we have going forward. The real problem that we have, all right, and the stock market's down today. Someone can tell me why. Why is stock market down today? Yeah, good jobs report, right? You think good jobs report should make the stock market go up, right? Everybody should be happy, everybody has a job. Well, the problem is our real problem that we have, the real supply chain issue is jobs, right? So pretty much everyone who's trying to hire someone from work, you know, they set up this great party, they think everyone's going to apply to their job, and the doors open, and this is the number of people waiting, right? There's nobody there. I don't know how I got on a Parks and Rec theme, by the way. It kind of happened. I sent Steve the slides at like 2:30 in the morning, so I don't know. Anyway, right? Nobody's there, right? We have no more workers. Unemployment is 3.5%. It's the lowest it's been since the 1960s, all right? We're all back to work, all right? We're Backstreet Boys. We're back, all right? So we have the same number of people working. Actually, we've surpassed the number of people that were in the workforce working prior to COVID. Right, so if you hear these stories about people saying, oh, people aren't working and the great resignation and all this kind of stuff, people are not quitting their job to go get and be a Starbucks barista in Barstow. All right, people are quitting their jobs because they can go get 20% more money somewhere else for doing the same job. Right, no one has left the workforce. Right, the participation rate is the same as it was before. Right, in terms of the number of people participating in the economy. Can we put another nickel? There we go. It's on a timer. It's on a timer. Sorry, I probably should have had more bread before I came up here. I got some low blood sugar. All right, so the number of people working is exactly the same. So one thing I want you to tell you is some economists don't understand participation rate that comes out with the unemployment report. Right, so the participation number that comes out with the unemployment report is based on the number of people in the United States who are over the age of 18 years old. So that means that if someone in here has a 95-year-old grandparent, that person is counted in the participation rates that the Bureau of Labor Statistics puts out today. So if you look, the orange line is the line that the Bureau of Labor Statistics puts out. The blue line is if you remove all the people over the age of 65. Right, so the blue line is your true participation rate, which you can see is fine, but people, for whatever reason, look at the orange line and don't make an adjustment and say, well, we have like 12 million people who aren't participating. All right, well, that's if you don't want your 75-year-old or 85-year-old grandmother to be involved, right? So just one note on participation rate. All right, so what happens when you hit full employment? All right, the problem is everybody wants a raise. Right, everybody wants a raise, right? So I did a presentation for like 50 HR people and everybody wants a raise, right? And so right now wages are growing 7% year over year. And guess what happens if we give everybody 7% more money? Guess what they're gonna go do? They're gonna spend it, right? And if we spend more money, we're gonna have more what? Inflation. All right, you guys are with me. All right, because this is gonna be very important, all right? So what's the fix? How do we fix inflation? Well, these things don't help. So, it's really interesting. People really blame the Fed for what's going on in inflation. It is not the Fed's fault. All right, I feel like, Robin Williams and Good Will Hunting right now, if I was walking up there, this is not your fault. Like, I got the file there, this is not your fault, right? It's politicians' fault. All right, because we keep giving everybody free money so we're giving out $400 billion, and I work for a educational institution, so I should be all for this, right? Like, I'm economically incentivized by making school cheaper, right? In fact, please cover the dean's ears when I say this so he doesn't hear it, right? But we're getting rid of $400 billion of debt, so people have $400 billion more lending or borrowing power. They're going to go buy stuff. And the best is, if we give people more money, what did you guys say? What's going to happen? More inflation. So I got a wonderful idea. Why don't we give $1,000 to everybody to help relieve them of this inflation problem that we have? And then we're going to be shocked when there's more inflation, right? So we're going to be shocked. So anyway, the problem is that you have the Fed that's trying to slow people from spending, and then we have politicians giving away more money, right? And so basically we have these two big institutions that aren't working together very well, all right? And that's what's causing the problems that we have now. So what's the fix? All right, there's only one way to fix it, all right? And the fix is we have to make all the people that feel rich, we're going to have to make them feel poor. All right, and it doesn't, by the way, it does mean, no, I don't feel good about saying that, right? And by the way, I'll also say that, of course, there are people who are in need, who do need support, right? We do a lot of work at the center with, underserved individuals, right? But on aggregate, these ideas of just giving everybody money doesn't make any sense, right? So we're gonna have to make people feel poor. And if you listen to Powell, the last time he gave some comments, he actually said, we're gonna have to cause some pain, right? The only way you're gonna stop inflation is you have to get people to stop spending money. What's the only way to get them to stop spending money? Either A, you gotta lay them off, or B, you gotta scare the crap out of them and make them think they're gonna get laid off. That's the only way you're gonna get people to stop spending money. All right, so basically what the Fed told the labor market last meeting was, I must break you. Here, let me see if I can do that. I must break you. All right, that's actually more Stallone than what that guy does, but that's all right. I don't know if I'm allowed to have a Russian on the slide deck. Is that allowed? He must be Ukrainian. We'll have him on there. All right. So, some of you might have heard that we're already in a recession. How many read some headline like 3 months ago, we already were in a recession? All right, everywhere, right? All right. By the way, we are not in a recession. All right. In fact, I'm going to say in the moral laurels of it, Montoya here, I don't think that word means what you think it means. We are not in a recession. All right. So just to show you what a recession looks like, these are jobless claims. All right. So every Thursday morning, while you're asleep at 5:30, we release jobless claims. At least some of you are asleep, and I envy you. All right. You can see here, if you look at the last recession, you got the blue line, the gray line, and the orange line. Those are the last recessions. You can see, from the 8 weeks before, the recession starts at time 0, and then you can see jobless claims go up, right? Because during a recession, people lose their jobs. The yellow line, all right, is what's happening this year, and you can see jobless claims are lower now than they were when we started the year, right? And you can see in the jobs report today, right? We are not in a recession or anything close to recession, right? There's absolutely zero weakness in the labor market, all right? So this idea that we're in a recession is totally false. All right, so what's been going on, and how's the Fed gonna cause us to stop spending money, all right? Basically, the Fed's gonna put us in a recession. That's basically what the Fed's gonna do, all right? So when I was here last year, if I show you Fed funds, it would be that blue line all the way at the bottom. So expectations were at the end of this year, Fed funds would be at 1%. And then you can see over the course of the year, Fed funds have been going up and up and up. And now the expectation is that Fed funds at the end of this year will be 4.5%. So we're at 3% now. So the expectation the Fed's gonna raise 3/4 of a point at the next meeting and 3/4 of a point at the meeting after. Right? So the Fed's goal here is to get people to stop spending money and stop investing. That's really their goal. Right? Their goal is to slow the economy down so that aggregate demand meets aggregate supply. All right? And really the supply problem we have is people. Right? We can talk about cars all you want, and we can talk about whatever else all you want. It's all about people. People, there's no people left to hire. All right? The problem that we have with the Fed, though, is the Fed is raising rates faster than they've ever raised rates before. Right? Ever raised rates before. So this is rate increases all the way back until 1972. Right? So this is every rate hiking cycle from 1872. That little blue line that's sticking out at the top on the left, that is now. Right? So the Fed's actually raising rates even faster than Volcker raised rates, if you remember that from the 1980s. And the expectation at the end of the year is we're going to be where that red dot is, which you can see is much faster than we ever have in the past. Right? So the Fed is raising rates incredibly quickly. And the problem is that Fed policy takes a really long time to impact the economy. All right, so the estimate is it takes between 12 and 18 months for a Fed rate to fully impact the economy. Right? So in other words, the Fed has raised interest rates 2.25% in the last 18 weeks, right? And that won't hit the system for probably another 34 weeks. Right? And so the Fed keeps tightening and tightening and tightening, and they really haven't seen what kind of economic damage they've already caused. Right? And so per usual, they're probably going to go too far. The other thing I'll say is that it takes a long time to get supply to come on in places where you're limited. So we've been limited for chips the last XYZ number of years. And you can see AMD warned yesterday because of course demand for chips is down because everybody just upgraded the computer right as we put on a whole bunch of fabs. All right, the only place that we really can't help is the labor market, right, unless we allow for more immigration. All right, so my guess is economically I think we're probably at peak inflation or incredibly close. All right, but I think it's going to take us a long time to get down to the Fed's target at 2%, what you see in the data. And the real question, and the question I can't answer, and the question that's the most important thing to watch this year, is does Powell have the guts to destroy the economy to go from 4% inflation to 2%? That's the question. right? Because if it's 10% or 9%, I think all of us can see, hey, the guy's got to slow the economy down, right? We don't want to have double-digit inflation. But when inflation comes down from 8% to 4%, is he going to have the guts to keep raising rates to push us in a recession just to get from 4 to 2? He says he's going to, right? He's acting like he's going to. But the question is he? And that one I can't answer for you. We're going to have to wait and find out. Treasuries say we're going to have a recession for sure in 2023, right? So this is the yield curve. So if you look at the 10-year interest rate minus the 2, and it goes negative, that almost always means we're going to have a recession. That says clearly we're going to have a recession next year. But if you look at credit spreads, like risky people trying to borrow money, the higher this is, that means a recession. We haven't quite got there yet, right? So financial markets are expecting a pretty weak economy next year. All right, so in summary, I think there's some downside risk to the 1.2% growth, right? The Fed's raising rates. I can't imagine how the economy is going to accelerate into that. All right, long term, I didn't really talk about much, but I think less than 2% is probably the norm in the long term. The Fed's going to be raising rates to bring down demand. And again, the real question is, what is Powell going to do when things get a little bit better? All right, best way to describe financial markets. So I'm going to be real quick on financial markets because this is where things get sad, right? All right, I know some of you, when you look at your 401k balance, you want to throw your computer into the trash. I know some of you have just ignored the fact that you have a 401k. All right, but really the best way to describe financial markets is what happens about 2 hours after this. All right, 2 hours after that is basically how I describe financial markets this year. I'm glad you got that, that's good. I'm going to say something really mean, but I wasn't sad to see Leo die. All right, financial markets year to date. So one of the craziest things about the financial markets this year is basically everything's gone down, right? So typically we have bad stock market, bonds go up because people have a flight to safety, but these things are together this year. We have a bad stock market because the bond market is bad, right? Because rates keep going up. And you can see here, so long-term bonds is the black line, and you can see it's done worse than any of the 3 equity markets. Right, so if you own like 20-year treasury bonds, you actually had a worse return than if you owned the NASDAQ, right? Which is just crazy to think about with the NASDAQ down close to 30%. So that's the real pain this year. If you have a 60-40 portfolio, you're still down probably 25%, right? And for me, there's not a lot of positive catalysts for equities, right? So I think the economy is going to slow, so earnings aren't going to accelerate. The Fed's still going to be aggressive here probably through the end of the year. My guess is that the Republicans are going to win the House, right? So there's no more stimulus coming. And stocks are you know, they're not cheap, right? They're not really expensive like they were before, but they're not cheap either, right? So if you follow me, you know this is one of the graphs I look at. So this is the NASDAQ composite. So I call this exciting Robin Hood investing stocks divided by normal stocks, NYSE. All right, and you can see here that obviously this took off a lot during the pandemic. All right, you can see it's still elevated. So I'd say the NASDAQ stocks are generally still a little bit overpriced. All right, and you can see this if you look at other measures of stock market. So this is PE ratios. This tells you for every dollar of earnings how much you're paying in price. You can see it's a lot down from where it was before, but it's still not cheap, right? So we're kind of in this like no man's land where things are not as expensive as they were, but they're not cheap, all right? If you look at the relation between how much you're willing to pay for stocks, the PE ratio and rates, right? The higher rates are, the less you're willing to pay for stocks because there's more competition. You can see here where the little arrow is, that's where we'd be on the dot plot. Right, so you can see higher rates, the less you're willing to pay, lower rates, the more you're willing to pay. We're at the top of the line, so that would tell you that stocks are still pretty expensive. This is price to sales ratio. Bottom line here is, you know, NVIDIA makes video cards that people are using to mine crypto. By the way, how many slides do I have on crypto so far? 0, right? All right, that equals how much crypto you should own in your portfolio. All right, just to be clear. All right, so you can see NVIDIA is still trading at 12 times sales. At 12 times sales, not earnings, 12 times sales. And so my guess is these things will be overpriced. Tesla's 12 times sales. And Snowflake, I don't even know what that is. And that's like 34 times, 36 times sales. That's pretty crazy. All right, one of the things I always like to tell people is just because something has gone down 95% does not mean it can't go down another 95%. So this is Dogecoin, which is 92% off the high, and it only take another negative 96% return to get down to where it was pre-COVID. All right, so again, don't buy any crypto. That's my tip. All right, interest rates are peaking up. So this is the 10-year Treasury is close to 4% right now. It was down at, just to remind you, the 10-year Treasury was at 0.6% in March 2020. So long-term 10-year interest rates are 0.6%. They're at 4% now. The other thing that's of note, and I mentioned this earlier, is earnings estimates are coming down. The one thing that's been kind of saving the stock market from a total disaster is that earnings have been holding up. And you can see this is the forecast for 2022 earnings for the entire year on different dates. So on August 6th, the expectation of last year that earnings would be up, 6%. And you can see it peaked about 10%, and then you can see it's now coming its way down. So earnings estimates are actually starting to come in a little bit on stocks. All right, so let's putting it all together. I think markets aren't going to go anywhere fast. Right? I think probably we're in a range where things are going to go down some, they're going to go up some, because things aren't super expensive, but I don't think there's any catalysts out there to make things happen. I think you still avoid, there's some crazy stuff, right? Please don't buy any Bed Bath & Beyond, all right? Like you can go to the store, it's great, those blue coupons are awesome, but probably don't want to buy that stock. Crypto, don't even get me started. The one place I'm actually really optimistic is I think long-term rates are probably pretty close to the top. I don't really think 10-year treasuries will go much more than 4%. So I'm not telling you how to make investment advice, but I am putting my money where my mouth is. I've been buying some long-term treasuries when they're close to 4%, so I'll just tell you that. I think the market hasn't really priced in a recession yet, which I think we'll probably have one next year. And so when you see earnings estimates come down some more, I think that might be a good time to buy stocks. So that's just my tip. So I don't think it's going to be another 30% down from here on the market, but I also don't think you need to be in a rush to think that you're missing the next big rally here and becoming, getting your Lambo in 2025, I guess, is when you can get one next. All right, so hopefully, I don't know how I went, so hopefully not too far over. But the Fed, I think, is going to be very aggressive the next several months. There's no data that's going to come out that's going to stop them. I think the hikes are going to stall the economy, especially next year. And financial markets, it's going to kind of put equities in a box, right? Because the Fed's not going to stop hiking until basically earnings estimates come down. I think there's a strong possibility of a recession in 2023. And really how deep that recession is going to depend on whether or not Powell's willing to destroy us to get to 2%. Right, that's the open question of how deep the recession is going to be. And like I said, I think in the financial market field, I think probably long-term bonds is your best bet if you're looking for a place to stash some money. Again, that's not investment advice. Talk to your wealth manager or your financial advisor before you make an investment. That's my disclosure. Thank you, everybody. Thanks, Steve.
Yeah, I think we have a few of those wealth management people out here that'd be happy to invest your money for you. So moving on to our next speaker is Jordan Levine. Excuse me. And Jordan is the Vice President and Chief Economist at the California Association of Realtors, a statewide trade organization of real estate professionals with more than 200,000 members, of which I've been one for the last 35 years. Jordan is responsible for CAR's housing market and economic research, as well as policy analysis for CAR's legislative and governmental affairs efforts. He has a passion for home ownership, fair housing, and housing supply, and regularly represents CAR to its members, industry groups, policymakers, and in the local and national media. Jordan has a bachelor degree in economics from the University of California, Santa Barbara, Irvine, and a master's degree with merit in international economics from the University of Sussex. Prior to joining CAR, Jordan worked in consulting as an economist and the director of economic research, covering all aspects of California's economy and housing market for clients ranging from cities, counties, and the state of California to private businesses and academic institutions. I give you Jordan Levine.
Thanks, Steve. Well, I know if I don't screw this up too bad and get invited back that I'll ask to go before Chris next time. So, and I'll also make sure to load my deck down with some killer memes. So I really dropped the ball on that. But I was going to take you through just a little bit of the macro stuff as it pertains to the housing market. Housing is first and foremost on everyone's mind, it seems, as the market shifts and things like that. Because, as Chris talked about, rates are going up. The Fed is in this kind of militant war against inflation, and it's playing itself out in 30-year fixed rate mortgages for sure, with more room to go. And so one of the things I've been telling our realtor members is that, yes, we're kind of in for a belt tightening mode. We have a modest recession baked into our forecast for 2023, and we think that will mean that the housing market will also remain relatively soft. But at the same time, my goal is to kind of try and talk you down from the ledge a little bit. There's no reason to panic, as isn't 2008 again when it comes to fundamentals. And so even as we're kind of entering the next stage of the business business cycle or maybe well into it by now already, we don't have those same kind of fundamental imbalances that we had on mortgage borrowing and debt and all of that kind of stuff. And so, I was going to kind of agree with Chris that we're not in a recession, and more importantly, that we're not on the kind of precipice, but also just keeping it really real, that we probably are in for a bit of an economic recession as we enter next year, both because of the Fed's kind of hyper-aggressive approach to getting inflation in check, and also because I do think eventually we're going to see consumers start to run out of steam. You see all the money that they had poured into their bank accounts, wages that are growing because we just have so many jobs and nobody to fill them. But if you look at the inflation numbers and just how we've been able to kind of keep this consumer machine going, we're increasingly relying on more kind of what I would argue are unsustainable sources, right? We're racking up credit card debt. We're finally burning up all those savings that Uncle Sam gave us last year. And even as we're kind of, I would argue, probably more towards the pessimistic side when it comes to housing, unlike 2008, we think sales is going to be what bears the brunt this time around, right? You don't have all of those kind of ninja loans out there bubbling under the surface, all these people in 5-1 option arms that are going to have their mortgages reset on them. You have a lot of people in very low fixed rate loans, and these were folks that were kind of at the very highest levels in terms of credit worthiness, folks that were putting money down. We're, I think, still underwriting mortgages at like a 720 average FICO score, which is still just kind of off the charts. And so we do have a little bit of price softness, right? One of the things to keep in mind when it comes to home prices, at least the ones that we measure and report, is that they're median prices, right? And one of the things that's really characterized the last couple of years is at the top end in particular, as the stock market hit 40,000 on the Dow and Bitcoin went up to 66 grand and all of that stuff, was that we were selling a ton of $3 and $4 and $5 million plus homes, which is great news for this room, right? The Newport Beach economy has had a great couple of years, and as that kind of peters out, that will contribute to more softness in prices. But that's just because we're not going to see like 400% growth in $5 million homes going forward the way that we did when rates went down to 2.6%. And so for me, I think the bottom line is that yes, we're in for a tough economic time, but I think especially when it comes to housing, right? You want to think long-term, right? Because we have this kind of business cycle component that's going on right now, but then we also have this kind of structural challenge in California where we just have so many people, not enough homes to put them in, meaning that over the long term, prices, rents, all of that stuff have really only ever gone one direction. And until we really have a situation where our economy's been undermined by lack of affordability and out-migration, which we've suffered from for many years, really accelerates to the point where we're sustaining negative population growth and economic growth going forward. Again, I think that over the long run, we're going to be kind of longing for the good old days when the median priced home in California was $900,000 or whatever it was earlier this summer. So quickly, just want to show you, like, corroborate what Chris told you, right? That we're basically fully recovered on the employment front, right? Here in California, we've only got 50,000 jobs or so to go. That will probably be completely erased by the time we get the September number. We just got a great U.S. number. It's also been very consistent, right? Even with all the kind of starts and stops in the economy, California's kind of figured out how to operate during a pandemic. If there's a new variant or something like that, I don't expect it to have the same kind of economic impact that we've seen. It's also been very broad-based, right? Not only have we recovered almost all the 3 million jobs that we lost, even in those very hardest hit economies, and you can see Orange County's kind of middle of the pack. These are sorted from like most affected economies on the left, the ones that are very tourism heavy, right? All the way to the kind of very agricultural heavy sector or regions that were relatively unaffected. But regardless, even in those very tourism heavy economies, we're talking about, 85, 90% of the way towards full recovery across the entire state. So it's been very consistent. It's big in terms of orders of magnitude. We've added almost 3 million jobs over the course of the last couple of years, and you're seeing it happen all over the place. We had a bit of an increase in unemployment rate in August. Some people freaked out about that. This is one of those ones where I think unemployment went up for the right reasons. You had some folks come back into labor force. I think some of those kids finally got kicked out of mom's basement, right? And they're finally looking for jobs, and so this is, one of those indicators that actually is a positive. But even if you kind of take that recent increase in unemployment into account and you look back historically, right, we're in a very good position from a labor market standpoint, right? Everybody pretty much that wants to work has a job. If you want to go get a job that pays more money, you could probably do that too. That's positive, right, from the standpoint of, people who say 2 quarters of negative GDP growth means you're in a recession. Chris poo-pooed that. I do as well, because you're really hard pressed to go back at any point in time and find a more tight labor market than what we have right now. So why can't we just then kick our feet up and expect all this consumer spending and just throw away all those headlines? I do think that, the inflation numbers are going to be something that we continue to grapple with, right? And I agree with Chris that we're probably past peak inflation, but you can see the UCLA forecast. Our forecast is very similar to this as well. Inflation has peaked and is coming down, but it's going to be a long, drawn-out process, right? They don't have us getting back towards kind of target inflation till late 2024, and we will probably drop into that 3.5% to 4% range at some point next year. My concern is that the Fed won't take their foot off the gas. He's been very transparent about being super aggressive. I think he almost takes pride in his hyper-aggressive rhetoric, at least, and maybe hoping in the background that he doesn't have to follow through on those commitments. But I do think that is going to be something that we continue to deal with, at least for the next 12 to 18 months. And on top of that, I think that, there's a limit to how much we can ask consumers to continue to propel the economy. Consumer spending is still going forward. People are still employed. We actually still have wage growth that's in that 6 to 7% range, and yet we have inflation that's been outpacing that, right? And so if you look at how consumers have been able to kind of bridge that gap between even this robust earnings growth that they have and the cost of everything they're out there buying, is that they're drawing down those savings and kind of finally spending up all those stimulus checks that we got from the federal government. And you also see, especially on the kind of revolving debt that has really started to pick up. The orange stuff on the right-hand side, that's all the cars that we went out and bought over the last couple of years, the non-revolving credit lines. But you can see since about the fourth quarter or third quarter of 2021, the blue stuff has really started to pick up, right? And that is mostly credit card debt. And so, again, for me, I think that consumers have been the one bright spot. If you look at GDP growth over the last, I would say, 6 quarters since we hit bottom, or maybe even a couple more quarters than that, I think 90% of all the growth that we've seen has come from consumption. And that is why I'm less optimistic about the future. Consumers are doing great now, and they continue to kind of spend and feel rich, as we heard. But eventually, those credit cards are going to get maxed out. Eventually, you're going to finally spend up all that money that you've saved by not buying pants for all these years. And we're going to be in a position where consumer spending is going to take a step back, and we don't have a lot of other kind of, eggs in our basket, as it were, economically to fall back on. You can see that we did have 2 quarters of GDP growth, but we're already way past where we were in the kind of pre-pandemic era. Oh yeah, I did bring the chart, right? So you can see about 90% of the growth that we've had in GDP over the last couple of years has been the blue stuff, right? Which is people going out, spending money, taking their families on trips again. They're sick of being locked up. They have, not huge commutes, so they're going to buy that electric car and do all that other fun stuff. And we don't have a lot of growth coming out of business investment, residential, non-residential construction, all that other, stuff that goes along with it. And on top of that, we're grappling with higher rates, right? So it's not just that we're having higher prices to the extent that we are throwing that stuff on the credit card, right? It's costing us more to carry that consumption around. Chris already showed the yield curve. I would just kind of reaffirm that this is one of those economic indicators. It's like batting 1,000, right? People do not want to buy those 2-year bonds. There's not an appetite for 2 years out there. There's at least the perception in the bond market of extreme risk out there over the next couple of months and years. And you can see actually not just that we've been inverted, where the 2-year treasury rate's been higher than the 10-year, we're actually more inverted now than we have been in like 30 years, right? So it's actually pretty significant. Talked about the Fed funds rate jumping up just from 3.8% in June, right? That was the forward guidance coming out of the June meeting, is that we need a Fed fund rate that's about 3.8%. Fast forward to September, now they think they need a Fed funds rate of 4.6%, right? So again, they just are kind of constantly underdoing their forecast, or maybe overestimating their efficacy in being able to get inflation under control, and then that hasn't been the case, and then they constantly come out and backpedal, which is why I'm less confident that they're going to be able to get inflation under control quickly and get us back down to those kind of lower Fed funds rates that they promised. I'm not going to go through this whole primer on the time value of money, but I will just say that I think that even as a lot of this kind of Fed activity has been priced into the market, I think we still have some room to go, right? I think about mortgage rates in terms of like spreads on the overnight rate, right? You've got an overnight rate, you've got a 2-year treasury, you've got a yield curve, and you've got some kind of a mortgage rate spread. Well, if you just kind of take that build it up approach to thinking about where could mortgage rates go in the future, and we really do get to a kind of 4.6% Fed funds rate, right? We could be looking at 6.7, which is our forecast for next year's 30-year fixed rate mortgage, but it's possible that they might continue to kind of jack up that Fed funds rate estimate even higher as they kind of lack efficacy in really getting inflation back down to 2%. So I think it's, 6.7% is our forecast for mortgage rates. We think that most of it's been priced in to this point in time, but I also think there's a downside risk where it's not unthinkable that we could see 7.5, even an 8% mortgage at some point in time next year. We're already at 6.7. Again, a lot of this growth in the Fed funds rate is showing up at least in the 2-year and to some extent in the 10-year, and that's transferred through to a 6.7% 30-year fixed rate mortgage as of the most recent data from a couple of weeks ago. I think it just came out this morning, actually, that it maybe went down a skosh. The Mortgage Daily News number is down a skosh, but that's already a huge change from where we were at 2.65%, right? I always kind of tell people I'm the son of a guy who used to go around in the 80s joking about, having the kind of best mortgage rate in town. He had a 12.5% mortgage interest rate, and he'd always brag to his buddies who had 15% mortgages. And so from that standpoint, 6.7% is not like a particularly huge number, right? But it's the change from 2.65 to 6.7% that really takes a huge bite out of consumer purchasing power. This is a little interactive tool that we have up on our website that kind of shows what happens to a buyer's purchasing power as rates start to increase. So I just picked out a hypothetical family in Orange County that was making, what did I pick? $250,000 a year. I think I went to the higher end because we were in Newport, right? But we take that family and they want to put 20% down. They want to have a high appetite for debt. I'll take a 40% DTI on my mortgage, right? 40% of my income can go to mortgage, meaning that I can afford an $8,333 monthly mortgage payment, right? Well, at 3% interest, that family can afford about a $1.8 million home, right? Under those kind of circumstances, of which there's about 2,700 homes available for sale in Orange County in August that were at or below that kind of $1.84 million price point. What happens as rates start to shoot up, right? At just 6.5%, we're even a little bit higher than that now. That family loses about $500,000 worth of purchasing power just purely on the basis of higher mortgage rates, right? To keep that same $8,300 a month mortgage payment, that means they have to now buy a house that's $1.3 million, not $1.84 million. So this surely is going to impact the market, right? Not everybody can just absorb the $10,000 a month payment to continue to purchase that $1.8 million home. But what happens if you wait around and we do get to that kind of worst case, all bets are off, feds don't do good at getting inflation in check kind of a scenario, and you see an 8% mortgage rate, that could have even worse implications, right? Because then your mortgage purchasing power drops down another couple $100,000 just on top of that. And you can see each time the rate goes up, it's not just that you can buy a cheaper home, right? You also have less options to choose from. You go from having about 3,700 homes available under your kind of given price point to just half the market now, even though you're one of these people at the very high end of the income spectrum. So that's what underlies this kind of plunge in housing affordability that we've seen over the course of the last year, right? We're now at the point where 16% of California households can afford the median priced home. And I've been arguing with the team back at CAR to, decide whether we want to invert this, right? Do we want to start talking about how 84% of households cannot afford the median priced home in California? But this is a challenge not just for our members and realtors who want to, do more transactions and things like that. This is a challenge for home ownership, and I would argue a bigger challenge for our economy moving forward, right? Because you can crank out as many $300,000, $400,000, $500,000 a year jobs as you want, if those people have to turn around and rent $9,500 a month apartments, it starts to kind of counteract the benefits of these very high wage jobs. And the bad news is for the folks in this room that we're kind of in one of the least affordable housing markets in the entire state. So California in and of itself is less affordable than the rest of the nation. But Orange County in particular is even less affordable, right? Like you're talking about 88% of the households in Orange County can't afford that median priced Orange County home. And again, I think that is one of the reasons why we're fairly, confident that the housing market will remain slow, right? It's just that there's not enough extra income out there to absorb the impact to purchasing power. On the other hand, I'm also not like crying into my soup or anything like that. I think this is like total vindication of my UCSB student loan, right? Because we're seeing supply and demand just kind of rebalance the way that like your Econ 101 professor told you that it was going to. We've had a market that was just running so red hot for such a long time. We had so many buyers who had remote work options, 2.65% mortgage rates, right? The fact that those high income industries really weren't affected by COVID, right? Most of those job losses, the 2.8 million job losses I showed you, bars, hotels, restaurants, and retail, right, was the vast majority of those jobs. People working in tech were able to change jobs and make even more money than ever before, and at the same time as that surge in buyer demand, we had everybody pull their homes down off the MLS because we were like in a pandemic, and I don't want people walking through my house and all of that stuff. And so part of what you're seeing, as scary as these negative percentage growth rates are, is like a normalization from a market that was so incredibly out of whack. You can see that mortgage applications are taking a step back. Buyer demand is easing in the face of this reduced affordability, right? That's exactly what you would expect to happen. We're below 2020 and 2021 levels, which were like decade high levels, but we're now also below even pre-pandemic levels. And this is, again, kind of what you would expect if you went into an Econ 101 class at UCSB. Right? That you have a surge in demand that pushes up prices. People can no longer afford. Demand takes a step back, and all these sellers provide more inventory because they see homes are selling quick. They're selling for more money. That's how markets are supposed to work, and that's indeed what we're seeing play out. I would argue that we have a kind of hypersensitive housing market here in California, partly because of our prices, and so I think we kind of overshot over the course of the last couple of months. We've had huge declines of 25 to 35%. In fact, we dropped down to the lowest level of sales that we've seen in over a decade. You have to go all the way back to 2008 to get levels as low as we saw in July, but guess what? They might be finding bottom relatively early. I don't expect them to come surging back, right? But I also don't expect to continue to see accelerated declines on transactions. I think you're just going to see the market kind of dry up for home sales, but this is kind of an interesting chart, right? Because this is the Newport Beach home sales broken down by price segment over the course of the last couple of years. And you can kind of see this, or hopefully this is something that helps you feel less panicked, right? Because yes, we have transactions that are down about 33% Newport Beach this year, but guess what? They were up 40% last year, right? You had homes, particularly in the 5 to 10 million, 10 million and up, that were growing by 150% plus last year, right? And so yes, the market is normalizing and we're down 33% overall, but that's just because we aren't like more than doubling the amount of high-end home sales that we have been doing over the course of the last couple of years, right? And so to me, this is again a market that's working as expected. In fact, we're still growing in 10 million and up, right? We're up 25% through the first 8 months of those super high-end homes in Newport Beach. And so the newspapers would have you believe that the kind of sky is falling on housing, but actually if you look at where the transactions are today, and again, this is through the first 8 months of the year compared to the first 8 months of the last couple of years, yes, we're down from those kind of 12-year highs that we hit in 2020 and 2021, but we actually don't have much fewer sales today than we did in a normal year back in 2018, 2019, right? And I think that is important to keep in mind because yes, the market is challenging, but no, it's not plummeting the way that it was in 2008. Again, we were red hot, now we're going back down to just normal, like hot. What about the inventory side, right? Because that's the other piece of supply and demand. And yes, you can see here now that we're at a 3-year high for active listings across the entire state. We have more homes out there on the MLS than we've seen in a very long time. So then does that mean we should panic, right? We have supply and demand coming back into balance. You have buyers taking that step back. listings are going up. Is that a bad sign? Well, I would argue that the listings aren't really that concerning from a price standpoint, because the only reason why we have more homes available for sale is because fewer buyers are out there buying them, right? So when you look week to week, we're carrying more homes forward into the following week than we have been over the course of the last couple of years. But if you look at the number of new listings, right? So let me back up. This is total active inventory. If you just log into every single MLS in California, add up all the homes that are available for sale, that's this number that you're seeing here at a 3-year high, right? What if we ask what number of homes did we actually list onto the MLS last week? That's what this number is, right? And you can see we're not putting much more inventory onto the MLS every week than we have been for the last 3 years. Inventory's still tight, we're just not selling them as fast as we used to. There's no sign in this data, and this is weekly data, by the way, that runs right up through last weekend, that sellers are running for the exits, right? Again, you have a lot of people that are sitting in 2.65% mortgages. These are 720 plus FICO score, people who put money down. They're not gonna run away from those homes. Even if they buy a new home for the exact same price, it's gonna cost them a lot more, right? We showed that kind of interest rate effect tool that we were already talking about. And so rather than seeing a big impact on prices where all these people have negative AM loans and the 5-1 option arm and they just throw the keys back to the bank, they're gonna camp out in their 2.65% mortgage and wait and see what happens, right? You can see that this normalization where we have buyers taking that step back, more sellers putting their homes on the market, or at least more homes available for sale, more competition for those available sellers out there, that price growth has taken a step back. We're at 1.4% on a year-to-year basis. That's the slowest we've seen in a long time, but prices thus far are still going up in California. Newport Beach, you can see we don't have that same kind of inventory bounce back, so even though we're still, I would argue, seeing that similar trend in terms of sales normalizing back down, we haven't seen as many actives come back. You can still see that same upward trend, but we're not at the 3-year high that we were. That, I think, is also encouraging, at least from the standpoint of price stability, right? That you don't have this flood of inventory coming onto the market. In fact, we're putting on fewer homes onto the MLS every week in Newport Beach, even than what you see in the state as a whole. Those numbers are actually still dropping. So, again, in for challenging economic times, but nothing to suggest that we're in the midst of this major sell-off where folks are gonna all of a sudden start dropping prices like crazy. And actually, if you look here at the number of homes that are selling above list price, unlike the rest of the state, there's actually been more homes selling above list price in Newport Beach this year than there was last year even, right? So we're kind of outperforming, we're punching above our weight a little bit, as it were, compared to the rest of the state as a whole. And again, I think high income earners are doing better than everybody else still in this economy, but we are starting to see that we're falling towards those same levels. But again, if you look at where prices are, right, prices are still up this year compared to where they were last year. We're just not growing them by 35 and 40%. So as challenging as things are, we're continuing to move forward just at a much slower clip, right? And homes, I think, are taking longer to sell. You can see that the all property median time on market's up from 2 weeks last year to 20 days this year. That's still a very quick median time on market, right? My dad was a realtor in the 80s. He would have killed to be able to sell a house in 20 days, but they are taking longer to sell, right? So that's why I think even as we kind of are outperforming the rest of the state, more homes are still selling for a premium here in Newport Beach. They're taking a little bit longer to sell, and we do have more inventory, not quite as much as what you see in the rest of the state, but this kind of suggests that we will see that same kind of slowing that we see elsewhere, right? Because price growth is a function of how competitive the market is, right? The thing I think people really forget, especially home buyers, they're like hyper-focused on whether prices are going to go down next year or not, and they're not focused on the kind of long-term. A market shift is actually a good thing for people who want to go out and buy a home, right? If you have been getting priced out, if you've been getting out-competed by people with all cash and all that stuff, you actually see about 45% of active listings on the MLS last week had done a price reduction, right? That's been almost unheard of over the course of the last couple of years. They'll pay down points for you, right? I've heard of sellers buying down points for buyers' mortgages, which is a great thing in an environment where rates have shot up to 6.7%. These are all things you couldn't even consider back in 2020 and 2021 when the market was red hot, and you see that kind of happening here in Newport Beach. We're not at 90 or 45%, but still about 37% of homes have had a price reduction. I've kind of already alluded to this, but the last thing I wanted to just point out is that it's not 2008 2008 all over again. We don't have those ninja loans. We have, very high FICO scores. The amount of people with home equity is like through the roof right now, and you don't foreclose on a home that you have equity in, right? You sell it, especially in an environment where there's still people that want to buy. The other thing is home ownership is still like the one and only way, and I know all the Bitcoin people were like super pumped over the last couple of years, but if you look at the actual wealth stats coming out of the Federal Reserve's every 3-year survey, the people who own homes are the only ones with any wealth in this country. They're the renter number for real net worth, I don't think I brought it, right? But the renter number for real net worth is like 5,000. That's what it was in the late 1970s too. So you don't end up making all these whiz-bang investments. You buy the Bitcoin, it goes up, and then you buy a killer watch and Bitcoin goes down, and you're right back where you started. And that's kind of the tail of the tape there. The other thing is, the long-term kind of potential for housing, I think, is still there, especially in a high inflation kind of environment. And this is like one of my favorite charts in the world, but it's also one of the most depressing charts in the world. But I think it really explains California's kind of long-run price trajectory pretty well, right? Because we've added about 15 million people in the state over the course of the last couple of decades, and we have slashed the amount of new construction that we do in this state, right? And so anytime you have excess supply and demand, Econ 101 tells you that there's only one thing that's going to happen to prices. We've all tried to go to a concert or something where there's more people that want to go than seats available, and it doesn't take long for those scalpers to start standing out front winging those tickets for very high prices. And that's kind of where we're at from a fundamental supply and demand standpoint in California. Too many people, not enough homes to put them in, meaning that over the long term, prices really only ever go one direction. We have times where we're kind of out of whack, right, and way excess demand, and we shoot above that long run trend line, and then we come back down and things like that. But the long term is punctuated by a market where, again, we just have not enough housing in this state, and in some ways our kind of robust, fast-growing, top 5 fastest-growing states in the nation for jobs or high-wage jobs or all those different fun metrics that we can punch out are also our biggest weakness, right? Because it's butted right up against this kind of limited housing supply to produce some of the worst housing affordability conditions in the nation. Again, 6.7% in absolute terms is not like a particularly scary interest rate, right? It's a lot higher than 2.65%, but even during the dot-com bubble, even during the housing bubble back in 2004, 5, 6, we were looking at 6, 7, 8% mortgage rates. So the level of rates is not the thing that's going to break the back of the housing market in and of itself, but this adjustment from 2.65 to 6 plus is going to be a painful process that I think is going to be borne mostly by relatively low levels of home sales rather than plummeting prices. So here's our economic outlook. I think we're even more pessimistic than the Fed. The 0.5% negative GDP growth encapsulates a couple of quarters of negatives that are even worse than that, and then maybe a couple of quarters of positive coming through by the end of the year as we go through that modest kind of consumer correction. I'm only going to give you my projection for 2022, which we've recently downgraded. We're going to see sales down about 20%. We're going to have prices that are up only about 5.5% compared to the 7-8% that we originally forecast. The market has shifted very quickly as rates have started to go up. We also have kind of affordability that's going to continue to deteriorate. We're only going to end up with a 5.2% mortgage rate annualized this year, and that's why I think that we're still we need to keep our seatbelts buckled, as it were, because our forecast for next year is 6.7%, meaning that we could get up to maybe 7-something in a worst-case scenario before it starts to come back down. And I do think the big open question is, as Chris pointed out, what the Fed is going to do and how militant they're going to be. Our forecast assumes that they're going to maintain their kind of war against inflation at all costs, even at the cost of the broader economy, which is what is baked into that negative forecast. So even as we're more, I think, towards the pessimistic side in terms of our quantitative forecast, I also see this as just kind of a rebalancing from a period in time when we were so out of whack towards something that's just a kind of more normal amount of being out of whack for California. So I'll leave it there. Thank you so much.
The exits we go.
Okay, so there you have it. I think they were fairly well in alignment, maybe off by a decimal point or two. Some people I know need to leave, but if you want to stick around, we're going to try and do a few Q&A type questions here with, as long as we have these two gentlemen with us. So Jeff's out there somewhere, I think, with a microphone. If you raise your hand if you have a question right there. Okay. And please direct it to which speaker you want to answer.
All right, so my question is, the Fed is doing rates. What is the Fed likely to do with their balance sheet? Because there's a leverage as they're being more accommodating that is reversed when they're being less accommodating.
Yeah, I mean, I didn't kind of belabor, I didn't know how nerdy to go on the build it up approach to mortgage rate thing, but one of the things that's baked into my worst case, that 8% worst case scenario for rates, was an increased mortgage rate spread as a function of them not buying up all those mortgage-backed securities. That if there's a lot less demand, then those MBS are going to have to pay out more, and I think that's why you could see, I think in my 8% scenario, we go from like 170 basis point spread on mortgages, which is the average, to like 220 and 230, which isn't out of the bounds of what we've seen in the past. But I think you could see more fat baked into those 30-year mortgage rate spreads that could take us up to that kind of 7-ish.
My only comment is the Fed can't expand the balance sheet and raise interest rates at the same time.
Yeah.
Okay.
So it's either staying the same or coming down. I guess it'll shrink it quite a bit.
Next question. Right there.
Jeff's been training on a treadmill for weeks for this.
He got both knees done, so he's pretty spry these days.
No.
Yeah?
Did you pay for that?
This is for Christopher. From a corporate budgeting standpoint, what do you feel a percentage would be across the board for a 2023 cost increase ranging from salaries to rent expense, even third-party outsourcing?
That one's tough to answer. So if you ask your employees, they probably own like 20%. I think this is the hard, so I think right now inflation's 8.3% year over year, right? So if you're doing like December reviews, if you wanted to kind of keep your employees up with cost of living for the year, it's like an 8%, right? But I don't think people are giving that. With the merit, I think probably something like 6 is probably the average of what you'll see, or 6.5. I had the wage statistics up here close to 7. So I think that's probably, but third-party suppliers and everything else, it just depends on how much pricing power they have. For example, I heard Apple was going out TSMC about not paying their price increase, and then basically they had to pay it. So everybody has too much pricing power. So my guess is they're going to give you a price, and you might have to take it. But I think probably for wages, 6 or 7% this year is probably your starting point. Everybody has 3 other jobs they can take than the job they have with you. So I think you got to be competitive.
You could point at the core CPI. I think that's around 6, so that could give you some good backup for that.
Yeah. Next question, someone? Back there, Jeff.
Hi there, my name is Teresa Timms. I own TDR Mortgage and Real Estate Group. And I didn't realize that affordability was 19%. I thought that once it goes below 22 or 23, we're in pretty big trouble just because people can't afford it. Also, the credit card consumer debt has increased so rapidly, and people just can't tap into money, like they used to. They would refinance and get $100,000 and their payment would go up $100. What do you think is the pain point in unemployment number that we would officially be in a recession? And I want to know the future. I know it's kind of hard to predict exactly. And Newport Beach is its own little thing. So I just wanted to know your thoughts on that.
Long term, I think the affordability thing is a huge challenge. I think we have just such a barbell economy now, and we've hollowed out the middle. We still have a lot of high income earners that don't, bat an eye at $3 and $5 million home prices, and they don't care if the aggregate housing affordability is 19%. Like, I make $500,000 a year, I'm going to buy a house, and we have a lot of those folks that are out there. I worry about it from a kind of viability standpoint, from like future economic growth, right? Because I have a niece who just graduated. I guess now she graduated like 5 years ago, but it feels like just recently. But she got a killer computer science degree in programming, and she got like a killer job offer. When she was like 21 years old, making like $110,000 grand a year. She'd never even had a job before, right? And that was like supposed to be a killer salary. But then she went and looked at the apartments in San Francisco where that job was, and she ended up taking the $80,000 a year job in Denver because she could afford her own 2-bedroom apartment and not have 4 people living in like a $7,500 a month apartment or what have you. And so for me, it's more about the longer term thing than it is about like the business cycle, right? There's still going to be people that are doing well, and I think, Newport Beach is actually still, like I said, outperforming the rest of the state, you know what I mean, when it comes to the housing market. But, how can we continue to be competitive economically, right? When you can go as an employer to your max possible, amount of pay, or even if she did go up to the 8.5%, 9%, wage increase and paid more than everybody else, if the cost of housing's up 35%, right, then you're still 25% worse off than you were before. And I think that's something that that's kind of why I belabor the housing supply issue, right? And just the fact that we have so many people, not enough new construction, because it's holding back the housing market, and our members can't get as many people into home ownership as they want to. But I think it's going to hold our businesses back, and that's why you see like HQ2s, and people don't pick up and take their whole entire business out of California, but when it's time to expand, we do it, in other states, and I think that's directly, you can draw a straight line from housing to those challenges economically.
Okay. Next question up here, Jeff.
Love to know your thoughts on how do you measure productivity? And so that's one, and then just some of your thoughts on commercial real estate.
I guess maybe I'll take the productivity one. So productivity is incredibly hard to measure. So typically the way economists do is they look at real output of GDP divided by number of people working, and that's how you calculate productivity. So, whether or not productivity is up or down, I don't think productivity is done particularly well this year. And it could be because my friend has one of those devices from Amazon that randomly moves your mouse around while I was out playing golf. So I personally blame him for that. But I don't think work at home, and I know that a lot of people like to work at home. I don't think it makes people particularly productive. My father told me when I was a kid, 85% of people don't know how to work. And as I've gotten older, as young I thought it was mean, and now as older I think it's being nice. I know 5 people that have 2 full-time jobs, because each job only takes 15 hours a week. And they never have to go into either office, so nobody knows, right? It's not on a website, so they just don't have a LinkedIn account. And so I think productivity is down because a lot of people are not, they're do the minimum, right? And so I think productivity, and also, the productivity peaked back around 2001 when computers really started being integrated in the workplace. So I don't think productivity is going to be particularly high going forward, but that's just my personal opinion.
Love it. I forgot the second part of your question.
Commercial real estate.
Oh, commercial real estate? Yeah, I'm glad I work in the residential side for now. I think that there's not that same underlying structural dynamic that makes me as confident to say commercial prices in California will only ever go one direction over the long run. I think they probably still will. I think, we were talking about people getting back to work eventually. All it takes is, some job losses and some rising unemployment to make workers feel maybe not as firmly in the driver's seat, more willing to get back to work. And I think companies will probably take advantage of that and get people back into the office and things like that. But I think, that's one area where technology has played a big role, right? And then it's just been exacerbated by COVID. If you look at the kind of retail sales broken down between brick and mortar and online, right? Like online shot through the roof. I think online retail spending went up like 45, 50%. It's still up high, and growing from those levels. And I think that will be something that has more staying power is that, look, we love buying stuff on our couch in sweatpants and stuff. And I think that's going to continue. And meaning that there's impacts to residential and shopping malls. I think tourist-heavy areas like this, where it's more like destination shopping will continue to do well, but the retail strip mall and stuff where they, have the kind of frame store, the picture frame and the camera repair. Like I just saw the watch repair guy on the boardwalk there when I was riding my bike, and I think those types of businesses are going to have a challenge, and that has implications for vacant space. I'm shilling to hopefully convert some of that stuff into residential. What better way to utilize everyone wanted like office space and circumvent all the like environmental concerns, right? These are structures that are already there. All we got to do is come in and like divide them up and turn them into homes, and the parking's already there and all that. So hopefully we can get some tax credits to do some of that stuff too, and help some like commercial property owners that don't want to be in the game anymore, you know, and that's a win-win for everybody, hopefully.
Okay, I think we have time for one or two more. Anybody else?
Well, just running to the next, I'll make one comment on Newport Beach real estate and Orange County in general. You know, we use current residents as our level of affordability, but our market for people is not who lives here, right? So I always view kind of Orange County and specifically Newport Beach as top of the pyramid, right? If Orange County real estate becomes affordable, what's going to happen? Everyone from Riverside is going to move here, right? And I guess it's kind of funny, but it's true, right? I mean, why would you live in Riverside when you could live in Newport Beach, right? And Newport Beach is the same way. Why am I going to live in, I don't know, what town do I want to insult in Orange County right now? San Juan Capistrano, and you could live in CDM, right? And so what happens is you see these statistics, but the people that are moving our CDM are not people from like Irvine. They're people from, you know, that became rich in Denver and they want to move here. And so your market is very different, right? I've lived here 14 years. And at no point has Orange County real estate ever been affordable. And I'll be here for, I don't know how many more years, but I can promise you that Orange County real estate will continue to never be affordable until there's a huge earthquake and we're all dead. Yeah. Then it'll be cheap.
Okay, last question, Jack.
Have the migration patterns changed much from 2021?
Don't get good migration data except for from the census, and they're only on 2020. I can tell you from the home sales data that the 2021, we were already normalizing. 2020, I think, was the big year for exodus. Like if you look at the price growth and the growth in transactions in places like Mammoth and Big Bear and like the Sierra Nevada foothills, it really exploded in 2020. 21 was already starting to see growth come back to the cities. I don't necessarily think it was because everyone was going back to the office to work, but I think people who wanted to move to Big Bear did it early on, and actually that the areas that were doing the best last year and even this year were the kind of coastal core where most of the population and jobs are located.
I concur.
Okay. So that's our forecast. Hopefully you learned something here today that you can take back with you. Just want to do one quick round of thank yous to our sponsors and Leadership Circle members, the Balboa Bay Resort. Thank you for the great lunch today. My staff at the Chamber, Jeff running around the room here with the microphone, and of course, all of you in attendance. If you still want to come back to the Balboa Bay Resort in 3 weeks from today is our Newport Chamber Honors event. Citizen of the Year, David Beek, and Business Person of the Year, Mario Marovic. And of course, our signature event of the year, the Newport Beach Christmas Boat Parade, will be sailing in the harbor December 14th to December 18th. If you're not a member of the Chamber of Commerce, you should be. We'll see you next year.